Warren Buffett, one of the most successful investors alive, has said that when he dies, most of the money he leaves his family should go into one simple, boring investment, not individual stocks, not anything exotic. That investment is called an index fund, and it might genuinely be the closest thing to a shortcut that investing offers regular people. Welcome to What is Money 101, the channel that breaks down personal finance terms that sound complicated but really aren't. Every video, we take one term you've probably heard but maybe couldn't fully explain and break it down in plain English. No jargon, no fluff, just what you actually need to know. Today's question: what is an index fund? Let's get into it. An index fund is a type of investment that simply holds every company in a specific market index in proportion to that index, rather than trying to handpick winners. The most common example is an S&P 500 index fund, which holds a slice of all 500 of the largest publicly traded U.S. companies. Think Apple, Microsoft, Amazon, and 497 others, all in one single purchase. Here's why that matters. When you buy one share of an S&P 500 index fund, you instantly own a tiny piece of 500 different businesses across almost every industry. If one company crashes, it barely dents your overall investment because it's just one small piece of the whole. Compare that to buying individual stocks, where picking the wrong company can genuinely wipe out a big chunk of your money. Index funds trade that swing for the fences upside for something more reliable. Broad, diversified growth that tracks the overall market. And the numbers back this up. Over long periods, the vast majority of professional fund managers who actively try to beat the market actually underperform a simple S&P 500 index fund after fees. That's not an opinion. It's one of the most consistently repeated findings in investing research. Speaking of fees, that's the other big advantage. Index funds are passively managed. There's no team of analysts picking stocks. So their fees, measured as an expense ratio, are typically a tiny fraction of a percent per year. Actively managed funds often charge 10 to 20 times more, and that difference compounds against you for decades. You can buy index funds inside almost any account, a Roth IRA, a 401k, or a regular brokerage account, usually through a mutual fund or an ETF, an exchange-traded fund that tracks the index. None of this means index funds never go down. They rise and fall with the overall market, sometimes sharply. But historically, over long stretches of 15, 20, 30 years, the overall market has trended upward. And an index fund is simply a way to own that trend, without needing to predict which individual company wins. The practical takeaway: for most people, especially those just starting out, a low-cost index fund is one of the simplest, most evidence-backed ways to invest. You're not betting on one company. You're betting on the market as a whole. So that's an index fund explained. To recap, it's a single investment that owns a small piece of hundreds of companies at once, giving you broad, low-cost, diversified growth without having to pick winners. If this made something click, do me a favor, hit like, drop a comment with any questions or topics you want explained next, and subscribe so you don't miss the next one. This channel only works if more people find it, so sharing genuinely helps. Next up, what is the debt snowball versus the debt avalanche method? Two completely different strategies for paying off debt, and which one actually gets you out faster. See you in the next one.